Hello, everybody. Happy Thursday, and welcome to the Gold Rush. I am Sam Gatlin, editor of the Gold Rush, and joined by my esteemed colleague and co-host, Mr.
Hello,
Jason Perz.
everybody. Happy
How's it going?
and welcome to the Gold Rush.
Jason has the YouTube video on in his background, so rookie mistake there, Jason. Is this your first time on the show or what, bro? All right. So, anyways, let's give a little state of the markets. So, we want to talk to you all about Asia. There's a lot happening in Asia, and I don't think enough people are paying attention to what's going on in China, Japan. I don't know if you've taken a look at South Korea recently, but holy cow, South Korea is moving. I think energy is set up for a rather large 2026. So, keeping a close eye on energy. I'm not sure if it's quite ready to go yet, but that is definitely interesting to Jason and I. And
All
at the
right, I'm
Gold
back.
Rush, hey, Jason, what's up?
I was like, the music's on twice. And yeah, sorry, guys. Just totally newbie here. It's my
Yes,
first.
everybody shame him in the chat.
Give me
This
a
is his
break.
first
Yeah.
time.
I was like, Sam, your voice is doubling. Oh, yeah. Okay. Sorry, guys. Reset up all my computer equipment this morning after getting back in town. So it's great to be here. Excited to talk to Sam today about so many things. Thanks for covering for me, Sam. And we got so much stuff to talk about. I mean, it's a commodity bull market, and the only thing that's really not moving yet is energy and grains. The softs kind of made a big move, basically starting with cocoa. That was what, 2023 into 24, and then we had coffee and so on. Sugar really never caught up. A couple bids, but that's about it. But now we're basically waiting for grains. We're waiting for oil. But a lot of things are getting ready to start moving. Sam's been highlighting some of them, so we'll talk about some of them today. So what's going on this chart, Sam?
So here on slide number 2, we have tip relative to IEF. So this is Treasury. You know the whole tip.
Inflation
Treasury
protected
inflation
security.
protected security. That's a whole mouthful there. Relative to nominal yielding treasuries. So this is really, if you want it in layman's terms, this is the bond market's way of telling us what it's pricing in for inflation expectations. There's a lot of other ways you can measure inflation expectations, but these two ETFs, TIP and IEF, really do a good job of telling us what the bond market's thinking about inflation, Jason. And, a lot of people have, we had the whole tariff day back, what was that, April 2nd, I believe. We called that Liberation Day. I like to call it Obliteration Day, or there's a lot of different clever names you could come up with. Liquidation Day is another good one I've heard. You know,
Liberating. I think Sean said liberating traders from profits was another one.
yep, that's a good one. But there was a lot of narrative out there that this was going to cause deflation, and I never really thought that made sense. And the bond market kind of agreed with that narrative for a little bit, and you could see exactly what happened here. You had a textbook head and shoulders top. So I was open to the idea that tariffs would cause some disinflation, but we've seen a lot of contrary evidence recently in the commodities markets. We have gold that rang the dinner bell on March 4th of 2024, and it's been on an absolute rocket ship higher. And whenever that happens, you typically see more inflation, Jason. You typically see commodities at large catch a bid, and that includes copper, which just had its best day ever. And that includes things like lithium and other base and industrial metals, which we'll talk about later in the show. And, for me, this is a confirmed head and shoulders top, and the market is telling us that inflation is going higher, Jason. So I'm here for it. I want that. I want crude oil to trend higher. A lot of people, a lot of investors are not positioned for that. And I think that would cause a lot of pain for investors that are overweight, things like SoundHound AI and the whole speculative tech trade. So I'm here for it. I'm open to anything. And yeah, what do you think about this chart, Jason?
No, I love it because it's we always joke. I remember writing something early on for Straza, and it was on tips, and I was like, I was fighting it so hard to not put the title just the tips. But seriously, the reason why the tip ETF does matter, and the reason why it is like you could look at it alone, you can look at it against IEF. It'll tell you a lot, and it tells you when we get into these inflationary periods. Now, they're not the best investing vehicles. If you have you're a hedge fund, you have a different level of investing in inflation protected securities or spreads that aren't there if you buy the tip ETF. But it is something that you want on your watch list, something to keep an eye on, just like Sam has this chart. I think it's interesting, and how we all learn as traders is like you find something you like and somebody else has done it, and then you kind of take it and make it your own. Sam is putting up these great intermarket charts all the time. So if you guys make one for yourself, put it on your watch list. That's something that you guys should do. But I do think that this is screaming what you and I have been talking about this whole time, which is inflation is probably moving higher. Yields are moving higher, and there's no reason in betting against yields moving higher, which is funny because every single person we talked to was completely against this idea the whole time. We've been trending in this channel, and like I said the other day, if we had that channel, like if anybody has a chart of the 30-year yield, if you're looking at the 30-year yield and you see this massive spike up trend that happened from 2020, and then you see a consolidation and something that's ready to break higher. If it was NVIDIA, everybody'd be like, oh, I'm ready to get long NVIDIA. It's going to be over this level. I'm going to be long it. I'll put a stop under the flag or whatever. But because it's yields, everybody's like, no, it's impossible. Can't happen because that would hurt my portfolio and my trades. And it's like, you can't look at trading that way. Something also to think about and keep in mind, yields have been moving up since 2020. What has technology done? Has it gotten wrecked by this? Every single analyst in the world would say, oh my gosh, once yields go up, it's going to be, the basically valuations of these companies are going to go through the roof and they're going to fall. And that's going to be the end of technology as we know it. However, technology was the leading sector out of the 2020 lows. It's probably been the leading sector besides energy over the last 4 or 5 years. I think energy took it over for a little bit, but it might be leading once again. So I don't look at this as bearish that yields are going higher. I just think the rotation that we're seeing will continue, will just continue. Things like copper, things like materials, Sam's chemical stocks, things like that are going to probably continue to move higher. And, technology might just slow down a little bit, but I don't think it's going to crash or go anywhere anytime soon.
Totally, Jason. And there's been a lot of talk on the street recently about Jerome Powell. I'm not sure if you've heard of this situation, but a lot of people are not happy with this guy right now because he's not lowering interest rates. And you can point to some unemployment data or there's several economic data points out there that you could make the case that the Federal Reserve should be lowering interest rates. But Jason, all of the evidence is suggesting that interest rates should actually be going higher. Copper having its best day ever and resolving a multi-decade base doesn't really tell me that interest rates should go lower. It tells me the exact opposite. Interest rates are too low. They should be going higher.
No, I agree. I think everybody's looking at Powell and they're going, and to me, I just wrote a piece about Powell being, basically stuck between a rock and a hard place. He has nothing to do here.
I do not envy his position at all. That sounds terrible.
And not to mention, like if you've paid attention to the guy, and I'm not like a big fan of the Fed by any means, but if you paid attention to the guy, he has been the most data dependent that I've seen over time. Just sitting there and going, okay, this makes sense. Let's do this. Economy's overheating. We'll raise rates. Economy's doing this. We'll lower rates. I think that's been his go-to. And now that we're looking at the market and we see Trump going, hey, you have to lower rates. I think he's seeing what I see and what you see, which is if he was to come in and lower interest rates, like let's just say Powell's crazy. You know, he loses his mind yesterday. He comes in and he goes, you know what? I'm done with this whole thing. Trump is right. I'm going to start lowering rates. What would happen to the market? It would skyrocket. Like everything would sky. It's already.
Well, we have Wavy McFly in the chat here, Jason. He's pointing out the meme coins, and I'm really glad you brought that up, Wavy, because meme coins. There are no fundamentals here, Jason. This is purely a liquidity trade. When there's extra money in the system, meme coins are going to catch a bid. And I don't know if any of you have checked, but meme coins are ripping. Crypto is ripping across the board. We need higher interest rates, Jason. I think that's the bottom line.
I think you're right. I completely agree. We need higher interest rates, and that's the thing that's the only thing that's going to stop any of this. And the simple fact that the president's out there and saying these things is going to drive up the prices of things anyway. So if we just talk about the fact that he wants lower interest rates, one day he's talking about firing people, comes out that he says he didn't say any of that. Whatever we think is going on, he's going out there and saying it. And we think the next person that gets in is going to be more amenable to lower interest rates. So if that happens, and it doesn't matter if it happens or not today, the market's always forward looking. So the market's looking in the future going, okay, we're going to, at the very least, Powell isn't probably going to come in and start ripping the rates up in his face. I would be surprised. That would be amazing, but I really doubt that would happen. And to us, we don't care about the politics. We just want to understand what it's going to do to the price action. And so to me, it's like price action, at the very least, yields are going to still move higher on the long end of the curve. I don't know what could happen on the short end of the curve, but I know that it will be a mistake. Meaning, when I say that it'll be a mistake, I'm talking about what will the 30-year yield do compared to the Fed rate, or even the 2-year. What will it do compared to the Fed rate? I think if they were to lower rates today, I think the yields would just continue to move up.
That's what we've seen, Jason. They started cutting.
Well, everybody keeps saying this. And so, like, let's go back to, just an explanation for people who might not know. If you look at bond yields and you're going, okay, the 30-year yield's going up, but the Fed is holding rates at this, what does that mean? Well, the Fed controls the short end of the curve. That's these 3-month bonds. And that also puts pressure on the 2-year and so on. But when you start to get to the 10-year, the 30-year, this is what mortgage rates are based on. Now you're looking at those as more of the truth of what's going on inside the economy. This is where people borrow from. The banks borrow from the Fed rate, but normal people and everyday people and businesses and so on, they borrow from the long end of the curve. So we're seeing the truth here. And the truth is just saying, like, yields are probably moving higher. There will probably be a point where the Fed might have to pivot to move their own rates higher at some point. I don't think they're there by any means today. A lot of people would look at gold and say, well, look at gold. It's taken off so much. I think gold could be at 30,000, and I don't think the Fed would care. I don't think it would mean anything to them. Same with copper. It's like, yeah, copper is doing well, but they're not really going to freak out about that. Oil's the one that's on everybody's radar. People drive around, they go to their local store, and they're like, okay, well, I'm at the gas station. I'm paying $5 a gallon. I'm paying $6 a gallon. That's when people freak out. So they really try to get people from freaking out like that. So that's what's going to be the catalyst for them to possibly raise rates. But let's say this just continues. Let's say oil just stays kind of flat. And let's say copper moves higher, and gold, and all the gold miners, and lithium, and all these things that we keep talking about here. Let's say that happens. I don't think they would act much. I don't think they would change much until oil really moves, which is why it's always the key part of the inflation trade. It's the reason why people keep saying, Sam, Jason, there is no inflation. Do you see gas prices, oil? Look under the surface as a trader because we're trading it, but really for the Fed, they're going to pay the most attention to oil. And that's going to also put the most pressure on the CPI reports and so on, and the PCE report that they love to use for whatever reason.
Totally. All those inflation reports are very overweight energy. Correct?
Yeah. Yes. Very, very overweight energy.
So before we shift gears here, Jason, and talk about China, let's talk about your glasses. Mm-hmm. We have Rick in the chat here who likes your glasses. Where did you get those from?
Oh, these are very special glasses for people who are, when screens are a little bit too bright for you and lights are a little bit too bright, you get these very cool blue lenses on your glasses, and then you can stare at your charts all day long. Really, that's the truth. For me, it helps me to look at screens easier, light easier, and it's easier on the eyes.
They look good on you, Jason.
Thanks.
And this chart, man, I tweeted this out. I retweeted it yesterday. Ricardo, a star analyst at All Star Charts, put this together yesterday, and this is the Hong Kong Exchange and Clearing Company. That's ticker HKXCY, overlaid with the China Large Cap ETF FXI. And you can tell that these charts are twins. They dance together over time. And right now, the Hong Kong exchange is breaking out to new highs. This is, I think, how I think of this is like JP Morgan. You know, you can overlay JP Morgan with the S&P 500 for decades, and they're almost identical. You know, you could remove the y-axis from the charts, and you wouldn't be able to tell me the difference. They're very, very similar. And that's what's going on here in China. This is a bellwether stock for Chinese equities. So, you know, when I saw copper have its best day ever last week, the first thing that came to my mind was Chinese equities, because you can overlay China with copper, and also there's a very, very high positive correlation there over long time frames. So I think all signs are pointing towards a major rotation into China, and this is on the cusp of entering a brand new primary uptrend after 3 years of nothing, straight sideways. You know, we've seen some awesome moves off that 2024 low, but you know, Chinese equities, they haven't even started their uptrend yet, Jason. So what do you think about this? What does this say about the broader macro? Not just, you know, obviously we like Chinese equities, but is there anything more we can read into higher Chinese equity prices?
I would think, that thing called copper. You know, Dr. Copper really likes to move with China. And if China's been making a move, and not to mention, like basically since 2024, China has been making a move. If you talk to people, even myself at that time, I was looking at China and going, man, that'd be tough to buy because it's just continued to break down and break down and break down. And then it started to bottom out. And then we started to get buy signals in China for the first time in many years. And this at the same time, copper started to bottom out. A lot of people forget about that massive move in copper that happened last year. I mean, it made a huge move very quickly up over $5 and came back down very quickly. Kind of very similar to the China chart. But China kind of chopped around. It made another new high. Now it's consolidating sideways and looking to break out again. Looks like some interesting options trades as well for you options traders out there. But I think the biggest thing to look at is, and this is for me, emerging market growth. If you look globally at GDP, if you're a psychopath and you like to do stuff like that for yourself, go ahead, just like me. Anyways, if you like to look at that sort of thing and look at global GDP, if you look at the emerging market countries, they are all moving higher, all of them. They are all having really good years. They all have really good returns also. Obviously, if you look at anything from Poland, Greece to South America to Southeast Asia, it's all making money. And so I think that Dr. Copper is basically saying, like, we're still in this global growth cycle, and we're going to see money moving into these other areas. I mean, technically, even if you look at the US, like growth is slowing down and inflation is starting to tick up a little bit. We're kind of in a stagflationary style environment. And the rest of the world's in a reflationary style environment where they are having a little bit of inflation, but they're having even more growth. So I think the money's going to still just continue to flow into these other areas, these other currencies. I don't think the trade's stopping anytime soon.
Well, Jason, let me ask you about emerging market currencies, because I'm glad you brought that up. We actually have a chart of CEW, and here it is running into a shelf of former highs, and so far it's getting rejected pretty hard. So, and obviously we've seen a major move off the lows here. So, you know, it's kind of expected to see some consolidation here, but do you think that's what it's going to be? It's going to be a consolidation in the context of an uptrend, or are we going to be stuck in this range for much longer? And to me, that's kind of bearish for emerging markets if their currencies are rolling over like this, because that's been a major tailwind for them. It's very, very strong currencies.
So if you look at a lot of the currencies inside of it, they are above that level already. So for me, that's why I'm kind of like, yeah, it'll probably break out. I'm still on the side that it'll probably break out to the upside. And as a whole, when you look at the weightings of these things, sometimes there's so much weight in different things. But if you look at them one by one, you're seeing like, okay, the Brazilian real is holding up pretty well. Interesting. Just go down the whole list, the ringgit and so on. Whatever you're looking at, look at all of them and then kind of make your decision from there. Not to mention, I would look at, even really Europe. To me, Europe's really saying something. If we look at the Swiss franc, if we look at the euro, if we look at countries like Poland, Spain, and so on, like Europe's saying something. And so I would be very surprised not to see the currencies follow it. A lot of people are calling for the dollar to bounce here in a massive way and unrail this entire train that's been moving higher in emerging markets. And once again, anything's possible. The market loves to make a fool out of all of us at all times. So I'm not saying that's impossible. I am saying that there are plenty of periods where you see this downtrend in the dollar and it gives a boost to emerging markets. I know. We're all like most of the people who are watching are too young to remember a time where you could ever invest in emerging markets. So that's the reason why nobody wants to like even look at this and go and think it's something. But if you go back to 2000, like this is where your charts really come into play. Go back to 2000. Look at countries like Brazil. Look at countries in Europe. Look at China, obviously. Look at all these countries and get an idea of how these things could really move. And then come back and look at these things and say, is this near a start of a new uptrend, or is this a uptrend that's long in the tooth? To me, I think we're closer to the start of this uptrend, and I think it will kind of show, like, this is a great chart because it would show, like, hey, not only are we seeing it in the stocks, which are doing phenomenal, but now we're also seeing it in the currencies, which have not caught a bid in many years. So looking at this all the way from 2020 to today, I think this is another key chart that people should keep an eye on, looking for this to target 20 and then see where it ends up from there.
Totally. And let's shift gears a little bit here, Jason, and talk about natural gas, because you brought along this chart. I'm not sure what this red line is. Is that a moving average? Something like that?
Yes, it's a 200. So it's a 200-week moving average.
Wow,
And
just straight sideways. Wow.
And so that's the reason why I put it on there. It's just straight sideways. It's kind of been at this level. It's struggled around that level a bunch of times. Depending on the contract, it actually continues to bounce off of that level just underneath it over and over again. But this is the front month contract, the continuous contract. So for me, it's everybody keeps talking about natural gas, when to buy it, what to do with it. Very clear level right here. If you get above 3.91, I can't see that. It's very small. I think it's 3.91. But if you get above that, if you get above that, I'd say this thing's a buy. I want to see it close, though. I want to see a weekly close above that level, and then we'd get a nice trend there. I think it's consolidated, moved sideways long enough. Some things correct through price and other things correct through time. Commodities, a lot of the time when they're in uptrends, they correct through time. Think about gold recently. Gold is correcting through time right now. And now we have natural gas, which looks like it's ready to solve that correction and move higher, get above that level. I would buy this thing all day. I think this thing's going to take off at some point. Sam and I have been talking about a lot of the moves in the commodities market and how we're kind of moving into these different places, whether it's uranium one week, lithium the next week, copper miners, whatever it is. Natural gas will be a part of that rally as well.
And let me ask you this, Jason, because natural gas is part of the energy complex, but it doesn't really dance with crude oil or gasoline or diesel. It just does its own thing, and it's been doing that forever, basically. So do you think it'll stay that way? Like, it's probably not bearish for energy if natural gas is breaking out, but do you think crude oil will catch a bid if natural gas is breaking out here, or are you just not thinking about it like that at all?
No, I'm glad you brought that up because that's true. So just for everybody who doesn't follow me that much, I always talk about natural gas as the exorcist. meaning it does whatever it wants. It's basically its head spinning around. Most of the time, when if it's in my portfolio, I'll see a bad day in the stock market, like let's say Liberation Day, and like everything's getting blasted, but I'll see natural gas will all of a sudden be green and up like 10% for whatever reason. And then if everything's going up, natural gas will sometimes be down 10%. So it kind of does whatever it wants. But at the same time, it is a part of the commodity cycle. It does move with the commodities. It's just very different than the rest of the complex. The supply and demand dynamics are very different. There's a ton of supply, but gluts happen, and those gluts that happen usually create these massive moves in that market, and not to mention weather events and so on. So you will see natural gas move like crazy at certain times, but this thing is a good thing to be in your portfolio. It is a great diversifier. And then getting above this level to me is really the key here, because I'm not really going to bet on it for hey, the rest of the commodity complex is moving. I'm going to bet on it and, hey, technically, I want to buy it above that level and see where it ends up.
Totally, Jason. And another little sub-industry group of energy, if you will, is uranium. And it really doesn't dance with crude oil or natural gas or any, not coal or wind or solar. It does its own thing. And right now, nuclear energy is so hot, Jason. So you can see here that it recently had its second best day since 2008, and then it had its best day since 2008. Several weeks after that, and man, does this look good. It's climbing out of a beautiful base. You can zoom out on this chart too. This goes back for decades, and really what I'm talking about here is the Fukushima disaster. And nuclear stocks are still at an ETF level, I should say, still dealing with that overhead supply. Something like Camco, CCJ is already breaking out to new all-time highs. This is like the Exxon Mobil of uranium and nuclear energy. But yeah, I think this just reinforces what you were saying there with natural gas. This is just it's part of the commodity cycle. You see all of these things rally, and yeah, this is definitely a very strong rally in nuclear energy. And man, how I learned it in technical analysis kindergarten was the bigger the base, the higher in space. And right now, there are no bases bigger than energy. You can look at something like Camco breaking out of a multi-decade base, but you can also look at something like the XLE, still stuck below its great financial crisis highs. So if that ever gets going, crude oil and the XLE is going to be an awesome trade. But right now, uranium and nuclear energy is working. So I think we need to stick with that. Don't you think?
Oh yeah. My my annoying arrows on here for these big bases are always just basically because when we're looking at a big base like this, I'm not trying to think about it as in like how, what couldn't happen. I'm trying to think about what could happen, because this is a huge base, and then this thing breaks out. And if you've seen uranium rally, like if you've seen the sector rally over time, like it's crazy. It makes huge moves and very quickly. And uranium's already moved quite a bit. Like a lot of people, this hasn't been on many people's radar. You'll see some of the old school uranium bulls, like they always talk about uranium. They're always going to be bullish on it, downtrends, uptrends, whatever. But for people who are actually trading, this wasn't on many people's radar. If you look at it, even that point where it got above the 200-day, you're going all the way back to 2020. And at that point, nobody was talking about it either. So I think this thing's really going to take off. I think the sector is very investable. I think it's going to be tough because, once again, there's only only a couple big bellwethers in that whole sector. I like CCJ, just keeping it simple. Once again, it's kind of like if you're a crypto trader, let's say you're 40, let's say you don't want to really be in the meme coins. This is kind of the one you'd want to be in for the uranium sector. Like Bitcoin in the crypto sector, this would be your Bitcoin basically. So one of the biggest and best. The drawdowns aren't going to be as nasty, but there's a lot of names inside there for you guys who are going through picking. Look at URNM, look at Ura, look at the names inside of it. You're going to find a lot of names that are going to move and probably move like crazy. So I'll be excited to see where this thing ends up because I think, we are in a commodities cycle, and all the commodity stocks like uranium, nuclear, natural gas stocks, and so on are moving. So I'll be excited to see where this one ends up because I don't doubt this thing ends up another, 50% from here, and the whole sector as a whole starts to really break out and starts to do something crazy because a lot of people haven't seen a uranium bull market. So I'm excited to see it. It should be a lot of fun, and I hope you guys are ready to trade it.
We have a good question from Kirk French in the chat, Jason, asking if nuclear stocks can get overextended like non-commodity stocks. We've seen a 50% rally in CCJ over the last 6 months. Do you think it's too much? Does it need to cool off? Or
It's a great
is it
question.
more like the philosophy of big moves, start with big moves? I think that's kind of where my head is at, is that, at the end of the day, this is a huge base. So, like, whether or not it comes and retests that breakout level, I think the path of least resistance is decisively higher for something like CCJ.
Yeah, a couple of ways to think about it. One is I hate the word I'm very specific with certain words of trading. I really don't like the words overbought. I don't like the words extended because there's no way to know if something's really, really overbought or really, really extended. And I'm not saying like you can't,
Like a 70 RSI can go to 80. It can go to
yes,
90. It can go
yes.
to 99.9,
And I think when you start trading, it's something that gets in your head a lot, which is, you look at the RSI and you go, oh my gosh, we're overbought. I better get out here. And then the thing moves up another like 200% or something crazy. And that's very normal. That's going to happen to you a lot if you're looking at those type of indicators for that. They work great in ranges. If you're looking at a range and you're going, okay, it's oversold, I want to sell, fine. But if you're looking at an uptrend, you're never going to know. The only way you know how a trend ends is when the trend bends and breaks. And so for me, it's more of I want to just own these. Like I own CCJ. I've owned it for a long time. I want to run a very wide trailing stop and I want to let this thing run. If it's up 50%, like let's say I just put on the position and I got this 50% move, I'll have a 20% stop on it. I'll make 30%. I'll be fine with that. I don't need to trade it perfectly because once again, it's in an uptrend. I don't know if this thing ends up another 200% or if it stops here today. But the big thing is risk manage, position size well, and the rest of it is don't think too much into things being extended. And the other part I wanted to add, if you look at commodities really move. Commodity stocks really move. It's very hard to play mean reversion games with commodities. And it's very easy to play mean reversion games with equities. So if you're looking at something like this and you're going, okay, I want to buy the pullbacks, when is it going to pull back? Like you might not ever get that chance. And when you get that chance, here's a perfect way of explaining this. I have a system, still running to this day. It's basically to diversify the portfolios. It's a S&P 500 4 days down system. So basically we sell credit spreads or sell naked options, naked puts if the S&P 500, the E-minis, has 4 days down. So 4 days down, you're usually going to bounce there. The probability of that is over 80% of the time. It's a very high win rate system. Not huge moves, but high win rate. And so if you do that same system in oil, 4 days down in oil, I'm going to buy oil. You'd lose everything. You would get smashed. You'd get destroyed. And the system makes nothing. It's like a 20% win rate, no positive expectancy. You're never going to make any money with that system, basically. So basically what I'm trying to say here is illustrating the differences in equities and commodities. So I hope that answers your question a little bit better.
Totally. That was a great answer, Jason. And an interesting development here in the chat. I don't know if this is true, so fact check this, but Wavy McFly says that battery material tariffs now have a 93.5% tariff. And, it's funny enough you mentioned that, Wavy, because on Friday, in our commodities weekly column, we talked about lithium and battery stocks, and we outlined our favorite setups in this industry. We didn't know this tariff headline was going to come across the newswire, but the technicals tend to get us in the right place before the news hits the wire. I saw in the chart report a few days ago a great quote from Jeff DeGraff, who's on my Mount Rushmore of market technicians, said that today's relative strength is tomorrow's news. The market is smarter than anybody out there. The market is all knowing it. It was anticipating this tariff, whether or not you knew about it. The market knew that there was a potential for a tariff, and that's why the technicals looked so good on these charts, and that's why we're making a ton of money in these lithium stocks today. One of the ones that we outlined on Friday is up over 7% today alone. So, we're seeing a really nice bid there, and this lithium versus commodities chart, I think, is a really interesting one that not enough investors are watching, because this is exactly where lithium bottomed relative to commodities on numerous occasions. I count 1, 2, 3, and this looks like the 4th time that this is going to bottom here. And look at what happened after each time, Jason. You had huge uptrends, huge outperformance from lithium stocks. So if anybody out there wants to see our trade ideas from last Friday in the lithium and battery space, you can see the link that I dropped in the chat there. They're still actionable. Really, really sweet charts there. Anything to add there, Jason?
The Trump administration is very good for solar and lithium stocks. That's about it.
All right. We're going to keep a close eye on those, because
but
it's not just these headlines, Jason. It's the technicals.
Oh, for sure. But they
look really nice technically.
There's a funny story with that, and it gets back to 2020. During 2020, Biden was going against Donald Trump. And so before the election, every analyst came out in the world and said the same thing, which is, if Biden gets in, you want to buy solar. Basically, lithium moves with solar. Most of the time, you want to buy tech, you want to buy speculative tech. And then if Trump gets in, you want to buy banks and energy. And then what happens? Biden gets in, energy becomes the leading sector, and actually leads the way that whole time. Basically, his whole term, I think energy was the leader for the Biden administration. And before that, tech as well, but lithium, they were all moving like crazy during the Trump administration. So mainly what I'm saying is, it's not about Donald Trump, it's not about Joe Biden, it's about watching the price action. Know which way to go because of that. Don't listen to people on the news because they don't know anything. The president isn't moving these stocks one way or the other. Everybody's going to probably be in the chat being like, oh my gosh, tariffs, this, that, and the other thing. Yeah, sure. But at the same time, are we looking at price action as traders, or do you want to pay attention to that stuff that you can't control at all? I want to get at what I can control. So I can set my stop underneath, let's say, a support zone. I can buy something that's breaking out. I can control that. I can't control if some crazy headline comes out that most of the time doesn't matter. I can't tell you the last time I've sat there with the market, with my brokerage account open, looking at the news, wondering like, oh, what's going to happen to my portfolio? I have no idea what's happening during the day news-wise most of the time. If it's a Fed day, sure, I pay attention. Everything else, I have no idea. And it's never hurt me as a trader. It's only helped me as a trader. So I think it's too much noise, and our brains start to get to a point where we're trying to make so many decisions. And I think the more you kind of tune out things and just look at the charts and go, okay, look at Sam's chart. Intermarket analysis here is saying that this could be bottoming out. Okay, let's find stocks in the sector. Okay, these stocks in this sector that Sam found, they're breaking out of these zones. Great. Okay, I'm going to buy it and put a trailing stop. That's it. It's as simple as that.
So are you telling me that CNBC is not here to help investors make money?
I do not think they are, Sam. I do not think CNBC or Bloomberg or any of these people want anybody to make any money, because it's what they want to do is stoke your fears, get you excited, get you high and low. And honestly, there's no ability to do anything well if you're too high or too low all the time. And so if you look at trading, something as simple as why don't I ever put green or red on my charts? And something as simple as that is learning, psychologically, you will make different decisions based on just seeing red or green on your charts.
Totally. And you've taught me to not watch my portfolio fluctuations during the day.
Yeah.
I don't know how long you've been doing that, but it sounds like you've been doing it for some time. You just don't check your portfolio at all during the day because, it's nice to see your portfolio going up. Don't get me wrong. Like, I love making money, but like that is going to affect my mind. And that's not what I need. I need to stay focused on price, and that in the long run will lead to larger gains.
Yes, your decisions change when you look at it, the money fluctuating will drive your decisions to change the whole time. And that's something that a lot of people, like professionals, all know this. Every professional knows never to look at their account when they're trading. Just because you have a red day, you're going to make a decision. You have a bunch of green days, you're going to make a different decision. Instead of just following your price action, following the plan, you will change those things. And that's the thing that makes you a good trader is whatever it is. Like I'm not saying like my way of trading is the best. I'm saying that there's many ways to trade. And whatever it is, you have to just follow your plan. And once you're in a position, this is I think Bruce Kovner said this in the Market Wizards book. Once you're in a position, you have no ability to make good rash decisions about that position. You want to have the idea of, okay, here's where I'm in. Here's what would happen for me to get out. Let's say it breaks a trend, hits target, however you trade. And this is my risk management. I'm using a trailing stop. I'm doing a stop here, whatever you're using. And that's it. Past that, I watch this happen all the time with friends of mine who are much smarter than me. And we'll be in an uptrend. Like, let's say, somebody's like, oh, look at uranium. This is 2020. I think uranium's going to bottom and go crazy right here. And I'll be like, okay, cool. I'll wait for my signal, see if it comes. I get a signal, I get long. Most of the time by that point, I'm getting a phone call. Hey, man, uranium's changed. This administration's doing this, or this has happened. And this is going to, really hurt this trade. And for me, I'm like, I'm already in the position. And I always tell people that this, and it sounds kind of ridiculous, but it's the best way I have of illustrating it. If I had a position and like, let's say it was semiconductors a couple of years ago, it was, everybody was again, 2023, everybody was like, semiconductors can't keep going. They're all going to crash and so on. And my buddy of mine was like, look, this is going to happen. You got to know this is going to happen. I go, look, like if God came down to me and he was like, Jason, I know semiconductors are going to crash right now. I can see the future. You're an idiot. I would say, sorry, God, like I'm long. I don't have a signal to exit yet. I have to wait for my signal. And that would be it. And honestly, that's saved me a lot of losses over the years because like we were talking about earlier with the extended trades and so on. Semiconductors was a trade that was up 50%. And then like, some of these positions went up, 200, 300, 400. I mean, look at the video. We don't even need to talk about it anymore. But some of these trades went crazy after, 50% moves. So that's the same thing that you might see in uranium. Not saying it's going to happen every single time that way. I'm just saying that, you got to be open to the fact that sometimes, like Sam said, big moves can lead to big moves. And that's what I think is probably coming for the uranium sector.
Totally. Me too, Jason. Well, we need to get out of here, but if anybody liked what we had to say, you should check out the link in the description on YouTube. We'll drop it on our website, stockmarketmedia.com as well. But every week, Jason and I are out here talking about commodities, bonds, currencies, everything you need to be a successful macro trader in today's market environment. So if you want to learn more, check out the link in the description. You can get a risk-free annual plan for $12.99 a year. We will give you your money back for any reason, no questions asked within 30 days. So yeah, come check us out. We're crushing it, Jason, right?
Yes. So I think it's a great time to be a part of the gold rush. We've really nailed the last couple years. We go long. We'll tell you when to get out. We're trading everything. I mean, we're not just talking about gold here. We're talking about the energy sector. Anything commodities based, we cover it. And right now, everything is also commodities based because of the AI trade. So AI is going to need power. Where is that going to come from? well, we got to figure that out as well. So Sam and I are talking about just about everything over there at the Gold Rush. So definitely check it out. We'd love to see you. Hopefully you guys have a good week, a good weekend at this point, and we'll see
Totally.
you guys soon. Next
We
week.
got a lot of love in the chat today, Jason. So shout out to everyone being here. We really appreciate you, Mr. Zerby. We've got Jonathan, Wavy, Nick, everyone. I appreciate you being here. Hopefully you show up next week, same time, same place, and we'll see you then. Adios.
All right, later, guys.